Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday. Are we going to call it a party for today? Yeah, it could be.
Well, it's sunny in Vancouver for once.
Yep.
Although
cold. You know, at this time of day, I have to close the curtains, otherwise the sun is shining straight in. And it's a shame to screen it out, but it gets too warm. So here we go. Showtime.
Bob, we have a question from our listener, Michael. Hello, Jim and Bob. I hear that Europe is experiencing a winter as cold as Canada this year, at least below the Arctic Circle, with heating oil and gas at a premium. Bob, economically speaking, will Europe eventually warm up to Russia, given Russia's valuable natural resources and oil? Bob, is this a good time to buy Russian oil and mining stocks? Many are trading at decade lows with mid-single-digit PE ratios.
Yeah, good question, Michael. About buying Russian oil and mining stocks, well, I wish you luck in that one. Into that jurisdiction is a quagmire. You don't know what could happen to the company or whatnot. But an alternative way to go about it is that Canada, Toronto, and Vancouver stock exchanges listed companies are very good at oil and gas as well as mining exploration work, and they will go to jurisdictions where they know that they can be relatively safe and get if the shareholders get a return out of the prospect, they'll get some money out of it. So intriguing, but I wouldn't touch that with a 10-foot pole. Now, will Europe eventually warm up to Russia given their valuable natural resources? Not necessary. The best thing to do would be if Ukraine stays out of Russia, they have huge coal reserves, and Europe has huge coal reserves. Then they could free up the North Sea exploration again, start fracking and sideways drilling, and you got all kinds of energy just in their own backyard between England and Europe. And then also you could have LNG transportation from North America to Europe. So no, they're best to get. And Reagan, decades ago, said to Europeans, don't get hooked up with Russia and the pipelines because they will then use it for their benefit, which is what they're doing. So, wild politics, and I think Putin's venture into warfare shows signs of some kind of desperation in his position. I thought that when the war drums were being pounded by Joe Biden, I thought it was a distraction from his horrendous domestic disasters. But who knows? Maybe Putin's in a corner as well. But I don't see it spreading too far. I think it'll be isolated and soon over. And I'm not going to make the call on who's going to win. But we do live in wild times. Nicely timed question.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that you found for us today. The first headline, inflation-obsessed investors can't get enough commodities.
Yeah, of course, with any boom period, commodities go up in price, and that's even with a currency that's not being debauched by modern economic theories. You had decades and decades when England, the senior economy, was on a gold standard, but commodity prices would go up in a boom and down in the contractions, and that's the way it is. But what has become unrelenting has been the insane policy of central banks to depreciate their currencies. They seem to think it's necessary. They cannot accept that the business cycle will go about its own without their intrusion. And one of the most blatant ones here has been over most of the last decade, where the Fed every year said that inflation was too low and we got to get it up above 2%, or deflation will happen, and so they pumped the money supply, not understanding that the world was scheduled for another great financial bubble, in which case the huge inflation ends up in stock and bond prices. And then in the final stages of the mania, you get an economic, a business boom, which was interrupted by the lockdowns, but nonetheless, the business boom came in. And was a demand for commodities. So you've got then a huge party in commodities, but our technical work, which is designed to be, unprejudiced, it's showing that the action is generating excesses on our momentum readings. And it's also beginning to develop what we call a pattern whereby we can get a sequential sell. So in looking back to the last time we had these sort of numbers was in 2008, when commodities were soaring and crude oil soared to $147 because of the peak oil theory, that there was going to be no more oil existing. And then with the price advance, it really took the skills that had been developed in exploring and developing natural gas fields, and they applied it, which is the fracking and then the horizontal drilling, and they applied it to oil, and they got all kinds of the stuff. So, and of course, this latest rise in oil prices is due is beyond the increase that you'd get with a business boom. It was that Joe Biden, on the first day in office, took steps to shut down oil and gas exploration and production in the U.S. wherever he could. Shut down pipelines, the whole thing, and the result is they're now very uncomfortable with high energy prices, and Biden has been pleading with the Russians or the Saudis to put the price of gasoline down at the pump. So, I mean, the politics gets very insane, particularly when it comes to energy matters. So, as I say, to wrap this one up, the technical action is recording excesses. The play could run for, it may take a few weeks yet for the action to complete.
Well, when it comes to oil and gas and crazy policies, Quebecers love their SUVs, big gas-guzzling vehicles, but they don't mind buying their oil and gas from foreign entities. They don't want Alberta oil and gas, but they don't mind taking the royalty money that Alberta raises from oil and gas.
Absolutely incredible. Here they are. A pipeline from the west is almost there, and you could get Western petroleum products into Quebec. But here they want to have the tankers of disgusting oil steaming up the rivers, the pristine waters of the St. Lawrence, and they would rather have that risk than have oil and gas from the West. I mean, it really is pathetic, isn't it? And then they fully accept all the transfer of monies from oil-producing provinces into Quebec, and Quebec is the greatest beneficiary of what they call equalization payments. So tell me about it, Jim.
Another headline that caught your attention: China's provinces brace for weak revenues because they don't have property taxes and so on like we do.
Well, wherever they get their tax revenues, and these Chinese provinces and municipal regions have been raking in the money, and now it's declining. And this is also a feature of a post-bubble contraction. China is now in a post-bubble contraction that I think can't be relieved because there's just too much of a mess there. And actually it started, a year ago in March when there was the headlines on South Africa, Argentina, and Turkey. Their central banks had run out of liquidity, and the locals were suffering a credit crisis. And that was the leading signal on it. And then beginning last June, I remember a headline in China was that their junk bond yield had gone rising through 10%, and that was a shock. Well, the last I saw on it was something like 28%, which is double, almost a triple shock. So with this, you've got a contraction, and wherever the municipalities and provinces got their tax revenues from, those tax revenues are declining. So this is, I take it as classical post-bubble condition. You can't do anything about it.
Friends of mine who worked in China, I can't remember if they said their monthly tax bill on their pay was either $8 or $13. And he said that's all the taxation they faced. Yeah. And it didn't matter how much money you made.
Oh.
It was just a flat tax.
Oh, that's interesting.
So you can see why Chinese entrepreneurs would be encouraged if you just pay $8 or $13 a month tax, no matter how much money you make.
Yeah.
Yeah.
Well, no matter what the rate is, they're not raking it in like they did.
And I also asked our correspondent in Japan, James Corbett, how does China plan to pay for their debt? And he said they just plan to print more money. They don't plan to have more industry. They just will print more money. And, and Bob, what does that lead to?
Oh, massive currency depreciation.
Yeah.
And wrecking the financial markets and contraction and poverty. It's a classic path.
The U.S. Fed has found the culprit behind risky debt, and it's an enormous overblown situation. And they found the culprit behind it. Apparently, it's the Fed.
Yeah, that was a study published by the New York Fed, and on their blog site, and they looked into this huge surge in risky debt issuance and decided that the Fed had something to do with it. So with their chronic buying bonds out of the market and easing here and easing there, and then you get into a period of confidence where you even ordinary investors are reaching for yield, and they're buying very risky stuff. And of course, when there's a bid for risky stuff, there's going to be borrowers there with not many credentials out there taking advantage and raising as much money as they can. This is, again, to use the word, Jim, classic bubble stuff, a huge issuance of credit, way beyond what any company or any country can service once the bubble is over. And a lot of this is happening as they've been issuing debt to service, to pay off retired debt. And it goes on until it can't go on anymore. And then, when the we're going to use the term, Jim, inflation in bond prices. And bond prices have been massively inflated. And the example is a couple of years ago when the German 10-year note yield got to minus nominal. I mean, it was almost minus 1%, which had, in the whole thousands of years of interest rate history, had never happened before. So the opposite side of that is bond prices being bid up to the moon. And then also stock prices have been inflated hugely. You've got the crypto and Bitcoin phenomenon where it's now large cap stuff, and the price gains have been multiples, 20, 30 times the best price gains in any financial bubble in history. Like the first one, the South Sea Company of 1720, that was the darling stock, and it went from £100 to a little over £1,000. So just in maybe 18 months, it was just a paltry 10 times. But now the gains in the Bitcoin and crypto stuff is huge. So the conclusion, Jim, is that the really huge inflation has been in financial assets, and the inflation that's in commodities and the CPI is minor compared to that. And the dominant feature will be that in every previous great inflation in financial assets, when the bust comes in, most asset prices go down. And that's, I think, is the prospect ahead of us. And we're monitoring price changes in these things, where our subscribers have the benefit of getting the calls on the right moment. So without a practical set of technical tools and without financial history, we just wouldn't be able to see the same things at all. If you're, say, a central banker and locked into the theories that a central bank can manage the economy and don't know anything else, this real world is going to become very bewildering. But at least it was one step to have a certain portion of the New York Fed take a look at the huge surge in risky debt and conclude that the Fed had something to do with it. That is really very healthy, but it won't be widespread.
Twitter is selling $1 billion in junk bonds to fund a share buyback.
Oh, my God, yes. That one, I just took a lap because Twitter is a precarious company that took a public service and politicized it so that it censors freedom of speech and it deserves to contract. And then there are, of course, other people developing the equivalent social media that will be free of political controls. And so the company itself is vulnerable. But also, when I looked at that headline, it reminded me of Boeing's some years ago when the company went on a buyback program and spent $45 billion buying their own stock back. Now, this is a decision that's beyond the Treasury or Finance Department of a huge company. It involves the board of directors. And they became greedy stock market manipulators and were buying the stock back. So where they spent $45 billion on that folly, they scrimped on the engineering cost of developing the Boeing MAX 737 airplane, such that you had the tragedy of two crashes. And that was because they scrimped on engineering costs. So then I just looked it up the other day, and an update on it, and so Boeing suffered $20 billion in fines, and they lost $60 billion in orders for that airplane, all because of the board of directors got greedy and thought they could drive the price of their stock up. I mean, this is one of the greatest blunders in financial markets. It's disgusting. I hate it. That's why I brought it up, Jim, because it is just so repulsive.
And I'll never fly on a 737 MAX either. I don't trust them anymore.
I don't fly anywhere anyways. I trust my elevator to take me where I want to go.
Well, somebody asked me what my favorite ride at the PNE, the Pacific National Exhibition, was, and I told them the beer garden.
That's a good one. No, I used to like roller coasters and all those wild things, but not anymore. So, no, and I used to ski, and I used to mountain bike and whitewater kayak, and then you get over the hill and you're just too old for it. But, hey, I sure had some fun.
Oh, yeah. One crash and a broken hip at our age, and you might as well make sure you've got the will up to date.
Well, I did have some sports injuries, but as I told my daughter the other day, I said, I never really was injured while skiing. It was when I'd been sailing through the air for a while, inadvertently, and then inadvertently came down that I suffered the injury. And then I also said that I didn't have any injuries while I was mountain biking. It was the same thing. Boom, something happened, sailing through the air, came down and broke 2 fingers in my hand and all kinds of things. So technically, Jim, I was never injured while skiing or mountain biking. It was when I was flying through the air.
Yeah, it's not the fall that kills you, it's the landing.
Yeah.
Bob, thank you so much for chatting with us.
Okay, Jim, we look forward to next week, and away we go.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You can send your questions for Bob to info@housestreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.